Okay, that was Fed Chair Powell following the decision to cut interest rates by 50 basis points. Perhaps a bit of a surprise today. Chair Powell saying moments ago, you heard it in the news conference, that there is greater confidence that inflation is moving closer to their target, that the labor market has cooled, but that the economy remains strong overall. Important to note, too, today that there was one dissent from Governor Bowman. That's the first from a position of that stature since 2005. Stocks have been a bit volatile following the decision. We can take a look now. We are higher across the board. We'll track it, of course, over this final stretch. Welcome, everybody, to Closing Bell. I'm Scott Wapner. We're live today in downtown Los Angeles at DoubleLine, and we are joined now by the firm's founder, CEO, and CIO, Jeffrey Gundlach, who always joins us on Fed Day. Thanks for having us here once again.
Nice to be here.
You said yesterday when we spoke 50 was your call. That's what you thought it was going to be. Now we have that. Now what's your reaction today?
Obviously, I'm not surprised because I thought it was going to be 50. I thought it was interesting that later in the press conference, Jay Powell admitted that they maybe could have gone in July. I remember when we met 6 weeks or 7 weeks ago at the July 31st meeting, I said I think they should have cut. And what probably spurred my confidence that this cut was coming was since July 31st, the two-year Treasury yield has dropped by more than 50 basis points. It's changing. There's a lot of volatility in rates today, too, after this Fed meeting.
What do you make of that? Why are rates up today, you think?
Well, the short end is down. Well, it depends what minute you look at it. I'm taking a quick look. I guess it is up a little bit in yield. It did initially rally.
Yeah, like two. I mean, I can look at it now as we have this conversation. 2s, 3s, 5, 7, 10, 30. Yeah. They're all those yields are up. Why?
Yeah, they're all up. Well, I think that the bond market at the long end is in particular where the yields are up. And the long end of the bond market doesn't want the Fed to be easing aggressively because they're worried about inflation. The rates have come down a lot this year on the short end, not very much on the long end, and that the Fed easing strikes the long end of the market as being inflationary, and so they're building in a premium against that. I think the word of the day was recalibration. He said it a lot of times, that they're recalibrating the rates. I think he seemed to relax to me. He even cracked a couple of jokes, which you don't see much from Mr. Powell. I think he felt good that he was now more in sync with the bond market. The bond market is very flat in yields from 2 years out to 5 years, even 10 years. It's right about 350, which to me suggests that the base case is that the terminal rate for the Fed funds rate, given current circumstances, is 350. And interestingly, they sort of said at the end of 2025, they think they'll be at about 350. And so he's now very much in sync with the bond market. And I think he was uncomfortably out of sync with what was going on, particularly with the two-year Treasury, which I always say the Fed follows the two-year Treasury, and they really had to do 50 to get more in line with that pricing.
You've made the argument, and you did again with me yesterday, that the Fed's behind the curve. The chair himself was pretty emphatic that he says we're not. Mm. Your reaction?
Well, now they're not so far behind the curve. I think they are a little bit because they're still up at 4 7/8 on the middle of the Fed funds rate, and the bond market's down at 350. But it seems to me that they're very open to keeping this process going. It's interesting that the next Fed meeting is after the election. Usually it would be before the election. I think they punted it a week. So they'll have a lot more potential to cut 50 in November than they would have if it was right before the election. Then it starts to, I don't really put much credence in this idea that the Fed is thinking about elections. Jay has said that repeatedly. I actually take him at his word. But I still think it would be rough if you did it 2 days before the election and had a 100 basis point cut.
The Fed is, I think it's fair to say, never really been in what you might call the insurance business, right? They're data dependent. They react when the data suggests that they should react. Was today a bit of an insurance policy?
Yes.
By doing that? Because he noted multiple times the economy's basically fine, he said. The economy's solid. He went on and on about that, and multiple times.
He used the words risk management more than once. And that strongly suggests an insurance policy type of mentality, at least partially, because he knows that the employment rate, the jobs that are reported the first Friday of the month, he admitted that they're artificial. He actually said that today, that there's something artificial about them because they keep revising them lower. There was that monstrous 818,000 jobs on the revision. And it seems to be happening consistently. He said, we'll make a mental correction now on the first Friday of the month they come out, which would mean about, just think of it as being 75,000 jobs overstated. And so I think if we get to an employment report that's at 100,000 jobs, that's going to be a real danger signal, because if you clip 75,000 off of that, you're getting down, you're starting to fly the plane near the tops of the trees. And also I want to point out, as I always do, that the household survey, which is also an important survey, tends to be more accurate at turning points in the economy. That has had negative full-time job growth this year, all through January. Now we're 8 months, negative job growth. And the part-time jobs are almost zero. So the surveys do not really jibe with one another, but they're clearly weakening, and he acknowledged that today.
But do you think the economy is weaker than the Fed chair himself just said?
I think the present data supports, and it's backward-looking, but the present data, which is backward-looking, supports his statement that the economy isn't showing signs of significant stress. And GDP now, and the most recent quarters of GDP, they're showing up at about 2% real, which is pretty solid growth. I mean, it's the growth that the CBO uses to make their predictions into the future. But I do think that the interest rate problem with credit cards in the economy is significant. I think the level of debt on the consumer is very high. And so I expect to see weaker economic data in the coming reports. I still think there's a good shot that the history books will say September of 24 was the start of a recession.
Steve Leisman.